What if the biggest players in global finance already know something most people don't? What if behind the public messaging of stability, diversification, and balanced portfolios, the world's largest institutions have been quietly preparing for a future built on a metal most investors overlook? And what if the recent tightening of rules around physical silver isn't a coincidence, but a response to a growing scramble for a resource the public still believes is abundant? The story isn't about a prediction, it's about patterns. Patterns in how banks behave before major shifts. Patterns in how regulations suddenly change when an asset becomes strategically important. Patterns in how the public is always the last to understand what the smart money is already positioned for. And today, that story leads us straight to silver. The metal once dismissed as too boring, too abundant, too old-fashioned to matter in the age of digital everything. Yet, in boardrooms and vaults around the world, a different narrative has been unfolding quietly, almost invisibly. Silver has been flowing out of publicly visible inventories and into private hands at a pace that even analysts have struggled to explain. To understand why, we have to go back to the origins of modern banking behavior, back to the first cracks in trust, back to the metal that helped build the monetary world we still rely on. Because once we understand the origins, the rise, the breaking point, and the fallout, the modern picture becomes clear and deeply unsettling. For centuries, silver wasn't just another commodity, it was money. Empires rose and fell on their ability to mint it. Merchants trusted it when they trusted nothing else. Bankers built entire systems around it because they understood something simple. Silver was both a monetary anchor and a strategic resource. When the United States formally ended silver's monetary role in the late 20th century, the assumption was that this was a one-way transition. Silver would drift into a new identity, part industrial metal, part collectible, part relic of a previous era. Institutions largely stepped back. Retail investors became the main physical buyers. Silver was rarely mentioned in the same breath as power brokers or major strategic reserves. But history rarely moves in straight lines. And in the early 2000s, something unexpected began. Industrial demand for silver surged, not because of jewelry or coinage, but because of technology. Silver became essential in solar panels, electronics, medical applications, and emerging battery technologies. A metal once treated as quaint suddenly became indispensable. The shift alone would have strained supply. But then another force entered: financial distrust. After the global financial crisis, many institutions revisited the idea of tangible hedges, yet they did not advertise this interest publicly. Instead, something else began to show up in the data: declining inventories at major exchanges, rising deliveries to private vaults, and a pattern of long-term contractual purchasing that quietly tightened the market. Retail investors noticed the price, but not the movement. Analysts saw the movement, but not the intention. The intention would come into focus only years later when previously theoretical risks, currency debasement, geopolitical fragmentation, energy insecurity, began materializing simultaneously. Silver, with its mix of monetary legacy and industrial necessity, suddenly looked less like a forgotten artifact and more like a strategic asset banks could not afford to ignore. Every shift has a breaking point. For silver, it arrived when physical demand began to consistently outpace mining supply. For decades, recycling and stockpiles filled the gap. But by the late 2010s and into the early 2020s, global inventories started declining more visibly. This was also the period when restricted access quietly emerged, not in dramatic headlines, but in incremental changes. Lowered purchase limits at certain brokers, delays in retail order fulfillment during demand spikes, and regulatory adjustments aimed at increasing oversight of precious metal transactions. Each individual change could be explained. Together, they suggested a system preparing for constrained supply. Banks, whether through ETFs, derivatives, or private contracts, began taking more metal off the market. Large players increasingly opted for physical settlement rather than rolling contracts. These were not the actions of traders seeking short-term gains. They were the movements of institutions building reserves. At the same time, silver's role in solar and electronics manufacturing accelerated. Nations with aggressive, renewable energy goals began treating silver as a strategic resource. And whenever an asset crosses that line, from commodity to strategic input, private accumulation becomes both more urgent and more discreet. Retail buyers felt the shift not through announcements, but through availability. Premiums rose, inventory thinned, certain products became intermittently unavailable. And while the official line was supply chain disruptions, the deeper story was a collision between industrial demand, institutional accumulation, and a public that had not connected the dots. The system was entering a phase where silver could no longer play all its roles simultaneously. It could be an industrial metal or a widely accessible investment metal or a strategic reserve metal, but not all three at once. When a resource becomes constrained, priority flows upward, and the public rarely sits at the top of that hierarchy. The fallout of this imbalance didn't come in a single dramatic moment. It emerged as a series of ripple effects. Manufacturers began securing long-term silver contracts years in advance, locking in supply at levels that hinted at expectations of future scarcity. Mines struggled to meaningfully increase production despite rising demand because most silver is a byproduct of other mining operations. Primary silver mines alone could not meet global needs. Meanwhile, financial institutions began adjusting their exposure. Some reduced their reliance on paper silver products, claiming diversification, while simultaneously expanding private storage arrangements. Others limited their participation in markets vulnerable to physical bottlenecks. Retail investors interpreted these moves in isolation. A delay here, a rule change there, a supply crunch that seemed temporary. But institutions treated them as signals that the era of easy silver was ending. And yet, the public narrative did not change. Silver remained overshadowed by gold, cryptocurrency, equities, and real estate. It was treated as a niche interest. This mismatch between perception and behavior is one of the clearest signs of an underlying transition. When the largest holders of capital adjust their positions quietly while the public remains disengaged, something foundational is shifting. Attempts to fix the imbalance have so far fallen short. Increasing mining output requires years of development. Recycling can help, but only at the margins. Substitution in industrial manufacturing is limited because silver's physical properties are uniquely efficient. No amount of financial engineering can create new metal. The deeper issue is existential. Silver is now pulled simultaneously by monetary uncertainty and industrial necessity. That puts pressure on a system not built to handle both. This brings us to the modern moment, where patterns seen in past transitions have re-emerged with sharper intensity. Institutional accumulation is not only continuing, it is accelerating. Public inventories on major exchanges have fallen dramatically from their peaks, while private vault holdings have risen. Industrial forecasts now project multi-year structural deficits. Governments increasingly list silver as critical for energy infrastructure, and retail investors face more limitations, more delays, and more opaque pricing dynamics. Yet the biggest signal is the quietest one. Banks are not selling. When an asset becomes unimportant, institutions offload it. But when they steadily accumulate, reduce outflows, and reposition for long-term holding, they are communicating something, not directly, but through behavior. Behavior is often the most honest form of communication in finance. The public may still believe silver is plentiful, replaceable, and unremarkable, but the data suggests a system adjusting for scarcity, competition, and strategic value. History shows that major shifts are often invisible until they are overwhelming. Silver appears to be approaching one of these inflection points. 3 takeaways matter most. First, when institutions position quietly and early, they are responding to long-term structural forces, not short-term market noise. Their actions suggest silver is transitioning from a commodity to a strategic asset. Second, regulatory constraints rarely appear without cause. Tighter access for retail buyers typically signals tightening supply overall. These restrictions are not random, they reflect prioritization. Third, the public narrative rarely aligns with institutional behavior. When the story says one thing, but the movement of metal says another, pay attention to the movement. The warning is simple. The window of abundant, freely accessible silver is narrowing. Whether the future challenge comes from industrial shortage, monetary instability, or geopolitical competition, the pattern is the same. Large players prepare quietly, and the public realizes the implications only when circumstances have already changed. If you want to understand where this is heading, follow actions rather than headlines. Examine inventories, delivery trends, and the tightening of rules around physical access. The signals are there for anyone willing to look closely. If this perspective helped you see the patterns forming beneath the surface, stay with the channel. There's much more unfolding, and the next developments may reshape how we think about metals, money, and the future of financial security.